Have you ever looked at a business's numbers and seen something that just doesn't add up? Like, they're reporting these huge profits, but somehow they seem to be completely out of cash. It's a classic puzzle in the business world, and honestly, it trips a lot of people up. Today, we're going to solve that mystery. We're diving deep into two key accounting concepts, accruals and prepayments. Let's get into it.
Okay, so let's meet Mike Lung. His company's income statement looks amazing, showing a net profit of over $123,000. I mean, he should be popping champagne, right? But here's the kicker. When he checks his business bank account, it's actually overdrawn by more than $8,000. How on earth is that possible? Well, this isn't some crazy accounting error. This is the key to understanding how successful businesses really track their performance.
And this brings us right to what we're going to call the profit puzzle. It's this exact situation, this contradiction between a really healthy profit on paper and a totally empty bank account. And believe me, it is way more common than you might think.
So let's just ask the big question right up front. Is profit the same thing as cash? The short answer, a big, resounding no, not at all. And the reason why it really just comes down to one simple thing, timing.
This whole timing issue leads us to the two main ways that businesses track their finances, cash versus accrual accounting. You can almost think of them as two completely different timelines, each telling the financial story of the exact same company.
Let's break this down. Cash accounting, well, it's pretty much what it sounds like. It's simple. Money comes in, you record it. Money goes out, you record it. A transaction only exists when cash physically changes hands. But accrual accounting, that's a different beast. It records business activity when it actually happens, when a sale's made or a service is used, and it does this regardless of when the cash finally shows up or leaves the building.
And here are the rules of the game for accrual accounting, which, by the way, is the standard for most businesses out there. You recognize revenue when it's earned. That means you've delivered the product, you've done the service. And you recognize expenses when they're incurred. That means you've used up a resource, like electricity or an employee's time. See the key thing here? Neither of these depends on when the bill is actually paid or when the check clears. That's the secret sauce.
So how do we actually put this into practice? Well, the first set of tools in our toolbox are called accruals. This is all about recording business activity that has already happened, even if the cash part of the equation hasn't quite caught up yet.
First up, we've got something called an accrued expense. Just think about your own electricity bill at home. You use power all month long, right? But you don't actually pay for it until the bill shows up later. That's an accrued expense. It's something your business has already gotten the benefit from, but by the end of the accounting period, you just haven't paid for it yet. It's basically a running tab of what you still owe.
Here's a perfect example, a water bill. So, this company used over $1,000 worth of water in the last 4 months of the year. But the actual payment for that water isn't due until January of next year. Under accrual accounting, that cost is absolutely an expense for this year because that's when the water was actually used. It belongs in this period.
So to get the real picture of what's going on, you can't just look at the cash that went out the door. You have to take the $1,440 they already paid, and then you add the $1,240 they've used but haven't paid for yet. That gives you the real water expense for the year, $2,680. Now the company has a much more accurate view of its true operating costs.
All right, now let's flip this around because the same logic applies to the money coming in. Accrued revenue is money that your business has earned fair and square, but the cash just hasn't hit your bank account yet. You've delivered the value, you've done the work, but you're still waiting on that payment. So how do we account for that?
Take a look at this. A company has a time deposit that pays out interest every 3 months. Okay, so by the end of December, 2 months have gone by. That means the deposit has earned 2 full months' worth of interest. Now, even though the cash payout won't actually happen until January, the company has definitely earned that revenue in November and December.
So if the total 3-month interest payment is going to be $2,400, the company can recognize 2/3 of that, which is $1,600 as revenue for this year. You add this to the income statement, and suddenly you've got a much truer, more realistic picture of the company's actual earnings for the period. Now we get to the other side of the coin, prepayments. This is what we call it when the cash moves before the business activity actually happens. You're paying now for something you're going to get later.
A prepaid expense is exactly what it sounds like, paying for something upfront, like your business insurance or maybe next year's rent. But here's the really fascinating part. When you first make that payment, it's not actually an expense, it's considered an asset. Why? Because your company now owns the right to a future benefit, like 6 months of insurance coverage.
For example, let's say in August, this company pays $1,800 for a 6-month insurance policy. That policy is going to last them all the way until February of next year. So that single cash payment clearly covers 2 different accounting periods, right? We can't just throw the whole $1,800 down as an expense for this year. That wouldn't be accurate.
The right way to do it is to split the payment. The part of the policy that covers next year, in this case 2 months, worth $600, gets recorded as a prepaid asset on the balance sheet. Only the part that was used up this year gets recorded as an expense on the income statement. Make sense, right?
And the flip side of a prepaid expense is what we call deferred revenue. Sometimes it's called unearned revenue. This is cash you get from a customer for a service you haven't delivered yet. Think of a customer prepaying you. And because you now owe them that service or that product, it's not your revenue yet. It's actually a liability on your books.
Just imagine you're a landlord, and you receive a $10,000 rent check in December for January's rent. Awesome. The cash is in your bank account, which feels great. But the service, providing the rental space for the month of January, hasn't happened yet, so you haven't actually earned that money in December.
So if the total cash you received for rents during the year was, say, $40,000, you need to adjust for that $10,000 that's really for next year. That means the company's true earned rent revenue for this year is only $30,000. That extra $10,000 just sits on the balance sheet as a liability, waiting to be turned into revenue next year when you actually provide the space.
All right, so now that we're armed with our knowledge of accruals and prepayments, we can finally go back and solve Mike Lung's puzzle and see the true financial picture of his business.
So why does all this matter so much? Well, because accrual accounting gives you a way more accurate view of a company's profitability. It does this by perfectly matching the revenues you earn in a period with the exact expenses it took to generate them. It separates the performance of making a profit from the separate action of having cash, and that is what solves Mike's puzzle. His profit number includes sales he hasn't collected cash for yet, while his cash has been spent on things like prepaid expenses for the future.
And this right here is where it all comes together on the final financial statements. Those prepaid expenses we talked about, they show up as assets. They represent a future benefit the company owns. And the accrued expenses and deferred revenues, they show up as liabilities. They represent obligations the company has to fulfill. These are the missing pieces of the puzzle that bridge the gap between profit and cash.
So, the next time you look at a company's profit number, you'll know there's a much deeper story happening beneath the surface. Profit isn't just cash. It's a careful measurement of performance over a specific period of time. So the real question you should be asking is this: now that you can see beyond just the cash, what story are the numbers really telling you?